Hello, I'm Dave Nolan, Senior Investment Strategist at McKinley Carter Wealth Services, where we continually endeavor to help you master your wealth. Today, I'd like to highlight our first quarter market review and outlook report. In our year-end outlook, we forecasted a positive year for stocks in 2022, but cautioned that volatility would likely be higher this year and that bond performance would likely be challenged by a less accommodative Federal Reserve policy. While the stock market is down year to date, our forecast of greater volatility and poor bond performance was right on target. During the first quarter, the S&P 500 and international stocks dropped by 12%, the Russell 2000 index of small cap stocks dropped by 14%, and the NASDAQ 100 index, which is dominated by technology stocks, dropped a whopping 20%. Worries over inflation, rising interest rates, and the Russian invasion of Ukraine caused investors to rush out of large, mid, and small cap stocks, but especially those stocks that were extremely expensive on a price-to-earnings basis. Some particularly speculative stocks lost over 75% of their market value. The bond market also suffered in the quarter, falling nearly 7% as interest rates rose because of inflation concerns and the worries that the Federal Reserve would raise short-term rates throughout the rest of the year. Fortunately, a good portion of the damage experienced in the stock market was reversed in March as bargain hunters came into the market as it became evident that many companies were able to pass cost increases along to customers. While this is not good news for us as consumers, it is good news for us as investors. In our last report, we highlighted 3 risks to our forecast that stock prices would rise in 2022 and that much of the current inflation surge would prove temporary. Risk number 1, we said that COVID variants might continue to stall the global economic recovery. While a number of Asian countries are still experiencing elevated COVID cases and periodic lockdowns, most of the world is seeing dramatic declines in Omicron cases and economies are opening back up. This is certainly a positive for global earnings. Risk number 2, we said that high inflation might be more persistent than we expect. Inflation is currently running over 7%, well above the Federal Reserve's 2% long-term target, and at a 40-year high as reopening economies around the world are seeing sharp pent-up demand for goods and services. The Russian invasion of Ukraine, which first and foremost is a humanitarian tragedy, has turbocharged the inflation problem as about 40% of Europe's natural gas supply and 25% of their oil supply comes from Russia. Russia is also a significant exporter of many of the world's most needed commodities such as coal, nickel, uranium, aluminum, platinum and palladium, and iron ore. Additionally, Russia and Ukraine combine to provide more than 25% of global wheat production, as well as being large producers of corn and vegetable oil. Disruptions to these critical supplies threaten global food markets and are leading to spiking prices as countries and consumers must pay more in the face of shortages. And risk number 3, we said that earnings growth could be more than offset by valuation contraction if interest rates rise more than expected. S&P 500 earnings projections for 2022 are for about a 7% increase. This figure could be in jeopardy should corporate input costs eat into profit margins, and if the economy slows significantly due to aggressive interest rate increases by the Fed in an attempt to curb inflation. Persistently high inflation has historically led to a reduced valuation for the stock market, as inflation-driven earnings increases are not viewed favorably by investors as they see their purchasing power diminished. Despite the positive news about falling COVID cases and reduced hospitalizations, the inflation and interest rate concerns look to be with us for a while. Even with this negative backdrop, we still expect 2022 to be another positive year for stocks, though returns will likely be modest. While U.S. stocks remain expensive relative to their history, they are reasonably valued relative to still historically expensive bonds. In addition, corporate profit margins have held steady, and companies are flush with cash that can be used for stock buybacks and dividend increases. International stocks trade in line with their historical average valuations and are trading at steep discounts to U.S. stocks. Bonds should experience their second consecutive down year as the Federal Reserve raises interest rates to slow the economy and allay inflation concerns. We believe inflation is likely to peak sometime in 2022 as supply chain shocks ease and Federal Reserve actions slow economic demand for goods. While the outcome of the Russian-Ukraine war is unknown, History shows us that these types of conflicts are ultimately taken in stride by markets as they adjust to the new reality. In sum, despite an onslaught of negative news this year, war in Ukraine, roaring inflation, Fed tightening announcements, rising interest rates, commodity shortages, trade sanctions, and COVID, the resilience of the stock market has been impressive and is another indication of the inherent strength of the U.S. economy and the ability of markets to look beyond current events. Thank you for watching today, and I hope you'll enjoy reading our full markets review and outlook report for greater detail on the first quarter and our forecast for the rest of 2022. Take care, and we'll see you next time.